The promise of stimulus helped propel U.S. equities to their biggest daily jump since 2008. The S&P 500 surged more than 9%, providing some respite. It's a day after its worst session since 1987. So global stocks suffered their worst week since the financial crisis. Quite a bit of wealth destruction, losing nearly $6 trillion in value. Joining us now on the line is Ryan Lemand. He's the Senior Executive Officer at ADSI Investment Solutions. Ryan, great to have you back on the show. I'm trying to get my head around whether this bounce that we saw on Friday is a technical rebound, which we often see with big swings in times of crises, or whether this is really a market that is a lot more confident that the world has its head ahead in the crisis.
Good morning, Yusuf. Great to be back. Thanks for having me. We do think that it is a technical rebound. 1987 can provide us with lots of insight. So 1987, it lasted for around 30 days, up and down, swinging up and down, and I think we are in that scenario today. Just to let you know how we're thinking, if you look at fundamental value of companies, it's at A, and today the valuation of companies is at A plus 10. This plus 10 is the confidence of investors in the system and the ability of central banks to intervene, and that confidence today is very much shaken, so we do expect that 10 to compress and that prices continue to go down for the foreseeable future.
So run me through then what we might get from the Fed in the coming days as we prepare for yet another meeting. Maybe they'll even move with an emergency rate cut beforehand, or is the Fed likely to wait until we get real data on the economic damage that the coronavirus has done?
Well, Yusuf, if you'd allow me just to take a step back for 20 seconds. The problem is that central banks around the world, and particularly in the U.S., have used lots of ammunition to try to suppress economic slowdowns and recessions in the past few years, rather than intervening with economic policy and fiscal policy. So today, when it's really time for central banks to step in because it is a crisis, they have very limited maneuvering space. So yes, they can cut rates by whatever they can cut, but it remains very limited. The Fed's balance sheet is very much inflated, and they have very limited maneuvering space to do whatever they can do.
Ryan, I mean, you mentioned what the Fed can't really do anymore that much. You got a lot less breathing room. In terms of havens, we had quite a tumultuous week, and that's really across the board. Yes, year to date, there are some gains for some of these, but over the last 5 trading sessions was really hard. So for gold, for silver, for palladium, and for Bitcoin, especially so for Bitcoin, 40% down over the last 5 trading sessions. Is this a time to get back in, double down on those haven bets?
There are many, many bargains that people can pick up today. So what we're advising clients at ADSI is that, first of all, is to move to defensive stocks, move into counter-cyclical strategies, convex strategies that are relatively market neutral. And yes, there are some bargains with regards to Bitcoin, palladium, gold. Now, why did the sell-off happen on gold, for example? Because simply it went up so much that people sold it off so they can cover their margins where they lost so much on stocks. So that's a very natural move. So yes, there are many, many bargains today that investors can pick up.
Ryan, should I be looking at some dividend yield plays in the United States? Rates are going to go to zero, potentially maybe as soon as this week, and there is not necessarily a lot of plays in the value space. Is that the way to go here?
100%. So we are relatively negative on the credit markets in the U.S. Half of the corporate debt, which has spiked so much in the past years, half of it is BBB. So on the next slowdown, these will go to high yield, and there will be a sell-off there. So yes, absolutely, equities, and particularly defensive, counter-cyclical, and dividend-paying stocks. And you have many as well in Europe that are quite safe to buy, that are dividend yielding.
You have to wonder, Ryan, that after the series of efforts by policymakers, especially into late last week, what we're going to get in terms of keeping that momentum going into early Monday. The indications and the signals we've been getting, including from the Canadian head of state, were clear that the G7 is trying to coordinate a little bit of this. Are you expecting any major announcements then to really put a dot under the coordination efforts?
I'm not sure to what extent they can do whatever they can do. So we've seen in the U.S. 2 weeks pay, free testing. It remains relatively cosmetic. What is upon us today is the worst pandemic since the Spanish flu. this can be really debilitating. Back then, when we had Spanish flu, there were no planes, there were no international travel. So this pandemic can spread substantially. So the G7 today has to open up. Countries are holding to their medical supplies very close to the chest. They need to be exchanged. If you look at the number of critical beds per 100,000 inhabitants in Europe, it is really scary when you look at the numbers on the coronavirus. So they need to coordinate and exchange medical supplies where it's needed the most.
All right, we'll leave it there. That's Ryan Lemand. He is staying with us. Joining us now, and still with us, rather, is Ryan Lemand. He's the Senior Executive Officer at ADS Investment Solutions. Ryan, in many ways, you look at the China story, and for all those who feel like at the moment investing is like driving through thick fog with a lot of uncertainty and pretty much no visibility, is the route to recovery going to take a similar kind of narrative like what we're seeing at the moment in China? Because the resilience has been very notable in the last few days especially.
Oh, absolutely. And the numbers show it. So remember when I told you about fundamental versus stock market value of a company A to A plus 10? If you look at China, the Shanghai index is down year to date only 5%, for God's sake. And China is the epicenter of this problem. If you look at Beijing, it's down 14%. Look at Europe, down 30%, US 18%. This shows you the confidence of investors and the ability of China to step in, first of all, very forcefully with the fiscal policy as well as monetary. So yes, we do expect the pickup in China to be quicker than the rest of the world. However, the problem with China is that demand for manufacturing will go down from Europe and potentially from the US, and this can hit China over the medium term.
Ryan, in your conversations with clients, is that a point that you get across, is maybe rotate out of other assets and into Chinese names in particular?
We are still assessing rolling into Chinese assets. We're also advising clients to go to some of the GCC assets that we have. The GCC, in our opinion, has taken the right stance with regards to very strict containment, and they are taking commensurate actions from the central bank that go hand in hand with the medical policies they've taken, like they've relaxed loans. They're allowing SMEs to take loans because they expect strict containment to hit SMEs. So yes, there are bargains in the GCC, and we're assessing bargains in China as we speak.
You mentioned the monetary policy in China. What about the rest of Asia and Japan in particular? Are we going to get anything interesting out of the BOJ? I mean, the other central banks have been quite creative. Maybe it's time the BOJ thinks out of the box a little bit.
Oh, absolutely. Well, that's another central bank that has its back to the wall. So yes, they need to be really inventive. And again, this is the time of central banks, and unfortunately, they lost very, very valuable ammunition over the past few years, just trying to avoid the recession at a time when recessions are very important for any economy in the world. So yes, let's hope they do actually think out of the box. But I don't know what they can do.
Ryan, I want to run something past you in terms of the wider emerging market space, and we put this up on a graphic to really underscore the point, because the EM's taken the greatest strain over the last week. The JP Morgan Broad Index of EM currencies dropped to the lowest level compared with the dollar since inception in 2010, widely followed, of course, by the EMBI spread of EM credit. Compared with the developed world, that's risen to the highest level since the Chinese devaluation crisis of 15 and 16. Do I pack up and leave this trade, or do I, again, go in with a heavier hand because of the valuations?
Well, it's all about valuation at the moment rather than anything else. It's really about fundamentals. We're really looking at fundamentals because we will have an economic slowdown and potentially a world recession. And this can hit very, very hard. So people have to go back to their models, valuations rather than anything else.
It's all about the models. Ryan, it's been great catching up. Thank you for your time. That's Ryan Lemand. He's the Senior Executive Officer at ADS Investment Solutions.